Hello everyone, my name is Jason. Today we're going to be talking about adjusting journal entries. Now, adjusting journal entries are pretty similar to regular journal entries, except that they're at period end and they tend to be entries that we haven't yet made that need to go in the period, or entries that are correcting errors in the period. So for instance, let's say we had 10,000 in beginning inventory. At the end of the period we find that we only have 9,000 in inventory remaining. We need to correct the inventory balance that's on our balance sheet. To do that, we would just credit inventory by 1,000 to reduce it, inventory being a balance sheet account, and we would debit cost of goods sold, cost of goods sold being an income statement account. So we're reducing inventory by 1,000 and increasing cost of goods sold by 1,000. Now let's say we had supplies of 9,000 that we used up for the period, and we haven't yet recorded that. We would debit supplies expense, which is an income statement account, and we would credit supplies, which is a balance sheet account. So we're increasing supplies expense and decreasing supplies. Let's say that we also had 500 depreciation for the month that we haven't yet recorded. We would debit depreciation expense, income statement account, and credit accumulated depreciation for 500. Accumulated depreciation is a contra asset account, so it's an asset that has a credit balance. Instead of, a lot of people might think to credit equipment rather than accumulate depreciation, but accountants like to have a separate record of the equipment at its cost and the depreciation taken on the equipment. So instead of reducing equipment directly, we just do it through this contra account here. Now let's say we have $100 in insurance expense that's been used up. We would debit insurance expense by 100 and credit prepaid insurance by 100. Prepaid insurance being an asset account on the balance sheet. It's basically like if we paid 1,000 in insurance for the upcoming year. So we paid 1,000 in advance, then each month we would have to reduce it by 1 month worth of insurance. Once we have all that, we can then work on our adjusted trial balance. Now we have, usually when you're given a problem like this, you'll have a regular old trial balance which lists all the accounts. Here's our assets, here's our liabilities, our capital account, and this is our income statement accounts. It'll list all our accounts here and our totals at the bottom. If we do everything right, our total debit should equal our total credit. So on our trial balance, as long as it balances, we're in good shape. Once we have the trial balance, we need to change the account balances based on the adjusting entries we made. So for instance, here we increased cost of goods sold by 1,000 and decreased inventory by 1,000. So when we're transitioning from our trial balance to our adjusted trial balance, we would need to decrease inventory by 1,000 and then increase cost of goods sold by 1,000, which is what we did. And then for this entry, we would increase supplies expense and then decrease supplies. And here, supplies have been decreased from 20,000 to 11,000, and supplies expense has been increased from 0 to 9,000. And for depreciation expense, we want to increase that by 500 and then increase accumulated depreciation by 500. Accumulated depreciation again is a contra asset, so it's our only asset account that has a credit balance. We'd increase that credit balance by 500, and then we'd increase depreciation expense by 500. And for insurance expense and prepaid insurance, we would do a similar process. So insurance expense right here, we increase it by 100, and we're decreasing prepaid insurance by 100 to 900. And once we've done all that, all the adjusting entries, we can total it up, make sure the total debits and the total credits equal. If they equal, then we probably transposed everything correctly, so that's a good sign. So once again, we start with the trial balance, then we're given adjusting entries. Once we make the adjusting entries, we have to adjust the trial balance for the entries we've made, and that will give us our adjusted trial balance. Normally, if we were doing the full closing process, we would then move all our revenue accounts here into capital and then create a post-closing trial balance where we wouldn't have any of these balances right here. So we would just have these and these. But for now, all we have to do is worry about the adjusting entries and the adjusted trial balance, and it's not too bad once you keep in mind that it's pretty similar to regular old journal entries, and once we have the regular old journal entries, we just have to adjust the trial balance accounts for the entries we made subsequent to when the trial balance was made. And that's the basic process of the adjusting entries and the adjusted trial balance. I hope I've explained it well. If you have any questions, feel free to reach out to me. My profile link is below. Have a good day.